Michael McNiven. Michael's a senior vice president with Cumberland Advisors, where he manages the firm's retirement plan advisory business, and he also advises individual and investment management clients. And a special thank you to Michael for stepping in about 12 hours ago for David Kotok, who's not able to be with us this morning, who was going to moderate this panel. Michael holds a PhD from the University of Georgia, and prior to joining Cumberland, Michael worked in market research and business development for the Financial Times and was a professor at Rowan University. This morning, Michael's going to lead a panel discussion which includes Mark Adelson from S&P, Bill Hasselpin of Egan-Jones Rating Services, and Jim Nadler of Kroll Bond Ratings. And they are going to discuss the truly independent nature of rating agency research, comparing the investor-paid business model with the issuer-paid business model. So thank you for your participation, and we're looking forward for a fantastic discussion. Thank you.
Well, good morning, and thank you, Dom, for the kind invitation. We have quite a subject today about the rating agencies. I think it's a very interesting topic. You don't have to have a PhD in economics to understand that the rating agencies and what they do is related to and essential to the markets, and that what they have done and what they do in the future impacts everybody. Let me start by saying, of course, sad to not have David here, but in the spirit of David Kotok, as you all know, sometimes he's a man with a pithy phrase. He was talking to me one time, and he said, if you call the hen house and the fox answers the phone, what do you expect him to say? He's going to tell you everything's fine. I think that as a neutral convener of dialogue, which Global Interdependence Center is, we're not here to ambush anybody, but it's clear by the evidence that we see, it's clear by the public perception at minimum that is quite negative, that there's a problem, and that the credit agencies are a part of that situation. And so our job here today is to invite these fine guests who represent 3 of the 9 major agencies and have a discussion about business models and other ideas. Let me just pull out a couple headlines. From the BBC, do credit rating agencies threaten our financial stability? This is just random headlines from recent days. This morning, Europe weighs plan to reduce rating agencies' influence. And that was referenced in the earlier panel. Says a draft report from Brussels proposes sweeping regulatory powers that include the right to ban sovereign credit ratings if countries do not want them. They propose to have their own rating agency. There's another one in the news recently. Moody's must face whistleblower analyst claim, who was saying he was unfavorably discharged because he was trying to help them change what they were doing in the midst of the crisis. Let me give you a couple books that are out there that have credit ratings highly mentioned. The Big Short, Michael Lewis has some time spent on that. Confidence Game by Christine Richard. And listen to this one. All the Devils Are Here by McLean and Nocera. Janet Tavicoli, who is author of Structured Finance and Collateralized Debt Obligations, which is a newsletter, has suggested that agencies lose their NRSRO status. That would be the status granted to them by the SEC. And that's part of the discussion that we're having here. The nationally recognized statistical ratings organization, NRSRO system, in which rating agencies are given the imprimatur of the SEC in order to do their work. So there's a really robust discussion that we can have today, and I'm sure there'll be plenty of questions. I prefer, of course, we're here in the spirit of dialogue and conversation, but I prefer it be a lively discussion, and I'm sure we have an excellent panel here to discuss. So let me introduce our panelists. The format for this will be we'll give each of them a few minutes to present their case, present the information, where they stand on the issues, probably a brief discussion of who they are and the firms that they represent, and then we will have several questions up here, and then we'll open it up to the audience, and I'm sure there'll be many good questions from the audience. First off is Mark Adelson. He is a senior research fellow at Standard & Poor's. He's a former chief credit officer of S&P, and he joined S&P in May 2008. And prior to this, he was the founding member of Adelson and Jacob Consulting. I spoke with Mark earlier, and he said, I'm a real critic of the agency, or of the credit agencies. Now I work for him. So he'll have an interesting discussion. So let's welcome Mark Adelson.
Thanks. Good morning, everyone. I'm Mark Adelson. Yes, I have been a very vocal critic of the rating agencies, and that's partly why I ended up going back to work at S&P. Previously, I worked at Moody's for about 10 years, and I guess the other thing I should share with you in the spirit of full disclosure is that a long time ago I used to practice law for a living, and in some places they hold that against you. Fair is fair. I've told you now. What I want to say about the rating agencies today and the issuer pay business model is that it is the business model S&P is sticking with, and it doesn't get in the way of doing things that need to be done, responding appropriately to events like the financial crisis. I'm going to use a couple of slides and just go through them quickly for a couple of items. Obviously, as was highlighted on the previous panel, there was a disappointment with the way credits performed, ratings performed in the structured finance side. For the most part, the rating system performed well. Ratings on munis, corporate sovereigns, et cetera, were aligned with the behavior of the credits, but in structured finance, not so much. This slide highlights it very vividly. If you look at the row for AAA, what this tells you is that for a select population of credits, residential mortgage-backed securities plus CDOs backed by mortgage paper plus certain SIVs called SIV Lights, that's a small group. The cohort from 2005 to 2007 issuance, by the end of 2010, almost 23% had defaulted. Okay? Another 37% was downgraded to the level that it was close to defaulted. Okay? This is absolutely horrible. Rating agencies get it. Everyone gets it. Likewise, other areas produced disappointing performance. This is a selection of financial firms, and it shows what their ratings were at the beginning of 2007 and how much their stock price dropped over the two-year period, 2007, 2008. If you think in terms of like a structural model, a Merton model, the decline of the stock price is the erosion of the buffer against default. You see it's horrific. It's quite horrible. You know, you have stock price declines better than 90% on credits that were high investment grade. You think that's bad? This is worse. This is a bond insurance industry. Of course, that was highlighted on the previous panel, basically a complete blowout. So what do you do about it? Well, you sling on your tool belt and you get to fixing things, and that's why I joined S&P, was to try and make some of this right. And the The idea is to go back to first principles, to revive two basic ideas, comparability and transparency, as being at the heart of the rating system. Comparability is the idea that a given rating symbol, pick your favorite, single A, it should mean the same thing wherever, whenever you use it. Transparency is the idea that a rating agency is going to fully explain what it's doing. It had to replace the fundamental business proposition of saying, trust us because we've always done a very good job, which was going to kind of ring hollow, with trust us because we'll completely show you how we reach our conclusions. So these two things are at the heart. Now, digging a level deeper, comparability is actually a very important idea because the highest level users of ratings, a chief investment officer, chief risk officer, want to be able to use ratings to look across their entire book, across different sectors, and get a feel for what the credit risk is. A portfolio manager who just runs a book of corporate credit or just runs a book of muni credit may not care about comparability, but the highest level user does. Now, how do you do it? Right? Saying you're going to do it is, saying you're going to do it is easy. Saying how you're going to do it is a little tougher. Saying how you did it is actually what counts. And what we did to do this, and I don't want you to trust a word I'm saying. You can read this in the criteria articles in the publications. We used all the old tools that existed, default studies, Gini coefficients. We added, in addition, the idea of macroeconomic stress scenarios as calibration benchmarks for the criteria. That is in place, it happens, and if you read the criteria articles, you'll see extensive discussions, a lot of citations to old NBER research, for example. It's an extensive treatment of calibrating the criteria. One of the key articles is called Understanding S&P Rating Definitions. It's on our website. You know, I recommend it. Transparency. How do you deliver transparency? You create a uniform, standardized design framework for how you put criteria together. You set it up so that all the different steps fit hip bone connected to thigh bone, and then you stick to it. It took a while to create this, but you will see it very vividly expressed in the criteria articles from this year. Most importantly, the sovereign criteria and the bank criteria. Examples where, you know, wholesale recalibration of the criteria had to happen were commercial mortgage-backed securities, residential mortgage-backed securities, CDOs, covered bonds, counterparty risk, bond insurers, and banks. Places where the criteria didn't seem to be totally off, but we wanted to enhance transparency were U.S. states and sovereigns. And of course, there's more still in the works. So that's 6 minutes, and I'm going to stop.
Very good. Thank you. Our next participant, and this panel is focused on the business model, and we've heard from S&P. As I was saying earlier, we have 9 major companies, S&P, Moody's, Fitch, and there's Kroll, Bonds, AM Best, Dominion Bond Rating Service, Japan Credit Rating Agency, Egan-Jones, and Morningstar. Maybe I'm one off on that. I don't know. I got them all. So we are pleased to invite to our panel James Nadler, who's the President and Chief Operating Officer of Kroll Bond Ratings. I told him I wouldn't say anything about when he was in elementary school, since I didn't know him then. But he comes out of New England Asset Management, a division of General Re, out of the insurance business, and also as an Executive Vice President of Fitch Ratings. So let's turn some time now to James.
Thank you. Just in starting out, I will start by quoting Kermit the Frog and say, it's hard to be green. In this day and age, it's hard to be a rating agency person regardless of where you work. It's hard to stand at a cocktail party and say, oh, I work for a rating agency, and have people all of a sudden say, oh, well, I'm going to go over there, look nervous, and walk away. And I'll talk a little bit about how we can change that in a moment. I had moved my family to the beautiful bucolic Farmington Valley to work at a division of Gen Re, their asset management group, and I got a call from Jules Kroll. He said, would you like to come back into the fray of rating agencies? And I, having been at an asset manager, had become very critical of the rating agencies and sort of watched all the things that had happened and thought, yeah, that sounds interesting. It sounds fun. I like startups. This is my third startup, so I'm drawn to them. And I thought, well, yes, I'll give it a try. So I decided to come down and move my family to New York City, which my wife will tell you was not a hardship. And I had been there for about 6 months, and I was watching Charlie Rose, and it was Bethany McLean and Joe Nocera, and they were talking about their book, All the Devils Are Here, which I thought was a good book. And Charlie Rose asked them a question. He said, who was primarily to blame for the financial crisis? Without a split second of thought, they both said the rating agencies. And I looked up and thought, what have I done? I've just now started a rating agency, and this is what people think of rating agencies. And so it's a long way of saying I think we have a deep hole to work our way out of. But I do see some bright spots on the horizon, and I do think that if we change the way we look at traditional ratings and rating agencies and evolve, I think that the rating agencies can again, like they have been in the past, be an important contributor to the capital markets. The primary focus of this panel is issuer paid versus, and we talk about a number of things, but issuer paid versus investor paid. And we'll hear from Bill about Egan-Jones, and they're primarily an investor paid service. When Jules Kroll left Kroll, the firm that he had established over 40 years after it was purchased from Marsh McLennan, he wanted to do something that he thought would be meaningful, and he was always interested in private sector solutions to public sector problems, and the rating agencies were an obvious choice, and the lack of due diligence in the subprime area gave him a real opening because his career was built on due diligence. And his first notion was that he would create an investor-paid service. And he thought, well, this is great. I'll just go talk to a bunch of investors, and they'll all be thrilled, and they'll give me money, and we'll be off and running. And he quickly realized that that's not how the world works, and that and I can tell you, having been at Gen Re, that money at investors and asset managers is tight. When I started at Gen Re, or when I left Gen Re, I won't tell you what they charge, but when I left Gen Re, the average basis points that we were getting on a new client had declined by 2 basis points, which if you work at an asset manager, you know is a lot in the 5 years that I was there. So there, investors, it's not like they have a lot of money that they can throw around. There are all kinds of issues. There are issues of the public utility of ratings. So if I pay for a rating and it becomes public, well, why would I pay? It's like walking around and asking people individually if they want to pay for defense and saying, well, no, I don't want to pay, but everybody else will pay, so I'm fine. So I think that there are a number of issues that you have to think about. But Jules came very quickly to the realization that if you wanted to have a meaningful platform and you wanted to have a say in the capital markets, and if you had something important to say, it needed to be on a platform that was issuer paid. That raises the issue of conflicts. What are the conflicts? Well, there are a number of conflicts. And the fact that it took the financial crisis and the SEC to point them out, I mean, I have teenagers. I had teenagers. They're all grown now. But I didn't give them the key to the liquor cabinet and the key to the cars on the same day. And so the fact that it took the financial crisis and the SEC coming in and saying to the rating agencies, well, the guy who negotiates your fees shouldn't be the same guy that's rating the deal. Well, that's a great idea. Why didn't the rating agencies think of that? So some of the regulation, I think, was obvious, and it's sort of surprising that the rating agencies needed to be told that. Another great example, and you brought up surveillance. Surveillance is woefully lacking in some of the incumbents. It's one of the things that rating agencies should pride themselves on. The fact that when you took in a new rating, you didn't think about the consequences of how much it was going to cost to surveil it is surprising. The rating agencies still have operating margins well above 40%. If they really wanted to address the problem quicker, they could. So I think these issues are valid issues, and I think that the rating agencies need to confront those issues head on and begin to build trust again with the investing community. I think that the rating agencies are going to have, and I agree with Mark, he talked about transparency. I think that's important, although we have to be careful not to become a check-the-box industry, and we have to allow for innovative research. We have to encourage innovative research. But I think the key issue is that rating agencies need to forget about the past, when the rating was the thing that they valued the most and the thing that they produced for the capital markets, and begin to see themselves as an information company. Because the investors, I've talked to 150 over the year and a half that I've been at Kroll, and investors don't believe the rating anymore. And so rating agencies have to become better about producing the information that led them to the rating in a format that works for investors, that helps investors make their decisions. And so while still producing the rating, and we can talk about the regulation and the idea that we would strip ratings out of some of the regulatory bodies and the problems that that creates, but I think the rating still needs to be available, but I think rating agencies begin to really look at what they produce as a company and how they can help their primary user, and that is investors. I think that's all my time, and I'll answer any questions later.
All right, thank you. Very interesting. Our next panelist is Bill Hassepin from Egan-Jones Ratings, based here in Philly. Bill is the co-manager of the ratings desk, and he's been a part of many of their early warnings, as you can read in the program. He had a career at Philadelphia National Bank. I'm sure he has lots to say, so let's turn some time to Bill.
Well, thank you, everybody, for being here, and thank you for having me on the panel. Egan-Jones is sort of an interesting rating agency. I mean, to give a little bit of background and history, not that I want to go over that, but the company was founded back in the mid-1990s, but back then it was small, was a boutique firm, and I actually would say that while we do cover approximately 1,500 names now, we're still fundamentally a boutique firm with a core group of analysts. But over the years, the firm, our revenue models are literally the opposite of my colleagues here, where Egan-Jones Ratings does not accept a penny of issuer compensation. 100% of all of our revenues are generated literally through research sales. So, and again, not getting into the nitty-gritty details of, say, subscription packages, and all of you are familiar with stuff, with issues like that. Depending on, and literally how much you pay Egan-Jones is based literally on the number of reports you receive. Nothing more, nothing less. If you want the full coverage, then you pay X. If you want something less, then you pay X. If you want different industry coverages, similar to what the other agencies offer, from their subscription sales side. But literally, that is how Egan-Jones makes its money. From the comments about surveillance, I couldn't agree more. We review our companies minimum 4 times a year. And usually our earnings releases are out within sometimes that day of the earnings release, usually within a week to 2 weeks after the earnings release that's taken place. We find that our clients rely on us to provide them with timely, accurate information, and frankly, with the bark on. We're not very Pollyannic about we're not very diplomatic as per se. If we think the quality of financials is poor, we'll flat out say it. We can get into some issues on regulation a little bit later on, because we are just as affected as S&P, Moody's, Kroll, Fitch, vis-a-vis Dodd-Frank, although frankly I think there should be more emphasis on the prevention part rather than the SEC's check-the-box exercises that they're making everybody go through. But, where we tend to view ourselves, again, from our definition, we're not, we consider ourselves, no offense to the gentleman here, the only really independent firm as defined by a revenue model. Now, again, there's the other side of the argument, as Jim more than pointed out, your average investor is not going to wait 5 years to get paid in order for a firm to build coverage and hopefully be able to sell it. That's simply not even reasonable for that to happen. So I can understand, in my previous life I was at Thompson Bankwatch, so I worked for an issuer-paid firm, so I literally know about the internal conflicts of interest. Now it's quite relieving that I don't have any, that at least I don't believe I have any. So, analysts are allowed to be analysts, and it doesn't matter whether we downgrade, whether it's UniCredit or the United States of America. Neither pay us a penny. So it's in any type of revenue, and the revenue decisions that may go into, if a downgrade happens, I've seen it happen at Bankwatch, where a company where a bank would be downgraded and then decide not to pay its rating fee. And next thing you know, $200,000 worth of fees are out the window. And yet you're stuck with the dilemma, do you still want to cover the bank because it's major? I've seen that happen. I'm sure it's happened at some of the other firms where they get upset and just decide not to pay the rating firm anymore. Now, I tend to think that there has been a lot of flap on the rating agencies about not making the right calls, whether we go back to 2001, 2008, and frankly, maybe even coming up on 2012. I have my own thoughts about the next crisis that's coming. And in some cases, I think at grades higher than the analytical level, the revenue decisions could enter into whether or not a rating agency takes quick action. I tend to think, my personal opinion is, and I'm actually going to stick up for you guys, I think it's more internal bureaucracy that have more to do with movement than the actual compensation issue. I tend to think that it is what we have is, our firm is a lot different than the larger ones. We're very streamlined. We make decisions very quickly. And in the larger firms, and I experienced this at Bankwatch, it sometimes, from the time an analyst wants to take a negative action, it could be several weeks before that happens. And by that time, it's too late. So I don't know how much more time do I have.
Well, let's start with a round of questions specifically about the options that are available as a business model. If you think about this, you have the option of the issuer paid, which has been the historic piece. You also have some type of subscription service, which Egan-Jones has. You could have, as the Europeans are suggesting, a government agency, an FDA, so to speak, of ratings that could do that. And so then you're considering whether or not you think that's a good idea. Somebody has to pay the bill. Somebody has to cover the costs of the service. You could have, I call it the Vanguard model, kind of a not strictly for-profit entity that could do it, or some type of hybrid, which I'm sure most agencies are really not one or the other. Maybe Egan-Jones is one, or
well, we're the only, we don't accept
issuer or investor only. So I think there's a lot of good discussions. Let me try to tantalize this discussion, see if we can heat it up a little bit here. Think about the other industries and how they are compensated. If we had the health industry and we said to the doctors, you can subscribe whatever you want, and there's no regulation as far as your interactions with pharmaceutical companies or other agencies, so that they could then say, I'm only going to prescribe that which pays me. All of us know at a fundamental level that's probably not pretty good. That's not pretty good for any of us. That professional competence of that doctor, the medical competence, has been compromised, right? So that's an argument against kind of issuer type of model, right? On the other side of it, you have education in which people pay, and largely we don't see a lot of diploma mills. But you see that there's a way that people can do that. The other industry you can think about is journalism. And I know as a journalist or as a publication, you're out looking for what's best for the end user as your first and foremost priority, and sometimes that can go awry. Everybody who's studied newspapers knows that if you're an investor in newspapers and the newspaper just got a Pulitzer Prize, sell. Because they spent all their time trying to do excellent, excellent research, and they've wasted all their resources, right? So there's this inverse correlation to doing really in-depth work on the journalism side and yet having compromised your balance sheet as an enterprise. So I add that just to mix it up a little bit and ask the question about our current models. And we have represented here on this panel issuer-based, and the arguments there are it's the only feasible way to do it. Many people say that. And there's also SEC's Regulation FD, which says that information needs to be public. And if you are in a subscription model, it's not public, so that still has to be ironed out. I would like to give to the panel here, address the weakness of your specific company's business model. And I know that's a little different question than saying, talk your book. This is, what's the weakness of your model, and how briefly do you internally try to mitigate that weakness? We'll start with Mark.
Okay. Skipping over a lot of intermediate steps, the potentially most pernicious thing about the issuer pay business model is that it can promote competitive laxity, where rating agencies' scheme for competition is to give higher ratings to attract issuers. And the steps I skipped along the way are that the market has to view, a rating is a rating is a rating. So, everybody's AAA means exactly the same thing. They are substitute goods, not complementary goods. And that issuers employ a strategy of shopping for the highest rating at the lowest cost. So I can get a AAA with more leverage from rating agency X than rating agency Y. So the most pernicious thing is competitive laxity. But you combat it the same way newspapers, magazines, other media enterprises do as well. You separate your editorial function, we call it an analytic function, from your commercial function. You have rules and procedures to separate it, which is not to say there aren't famous instances in media. I mean, I'm sure many of you saw the movie, the Russell Crowe movie, The Insider. 60 Minutes doesn't run the cigarette story, or at least doesn't at first. I wasn't at the rating agency during the period in question of the financial crisis, but I never saw direct evidence of competitive laxity having been practiced. At most it was circumstantial evidence and people were jumping to conclusions. I think going to the point that the bill raised earlier, I think, notwithstanding that some people say everyone who works at a rating agency is either crooked or an idiot, I think for the most part they were good, honest people trying to make the right judgments. And to the extent there was an erosion of judgment, and this is where I think the danger is the worst, it can happen unconsciously. A conflict of interest can lead to poor judgment despite the best intentions. So I think that's casting the problem in its toughest terms.
Fair enough. Jim.
Excuse me. I think a couple of things. I think that there are inherent conflicts in every model. There are inherent conflicts in investor pay. People look at issuer pay and investor pay as if investor pay is perhaps the devil incarnate, and investor pay is this sort of great thing that excuse me. This great thing that, you know what, I'm going to let Bill talk for a minute.
How about we let Bill take a shot?
Yeah, I'm fine.
Okay. Well, okay, from our perspective, again, being, having been on both sides of the aisle, I mean, there's been a lot of talk about some investor, about, I can't remember the guy's name that was very critical of the investor paid model, saying that there could be conflicts of interest because the research could be skewed to suit one client at the expense of everybody else. Now, what that tells me is the individual that wrote that article has no clue of how a research-based firm actually works. Because, again, it's totally a subscription-based model. There's a set fee charged flat for everybody. You pay a rate based on the number of reports you receive. So if you have 1,000 clients getting the same report, are you going to do a favor for one client who's not going to pay you a penny more at the expense of the other 999? I'm sorry, it doesn't even pass the logic test, the basic logic test. So from the model itself, I think from our standpoint, it's, we're very happy with our business model. I don't see any conflict weaknesses in it. Where I see business weaknesses in it is the ability to rapidly generate revenues. I mean, it's much easier for an issuer-paid firm to generate higher levels of revenues, and it also opens up, in a lot of ways, the types of certain asset classes that, say, an investor-paid firm, while could do the work, but given the nature of the way the fees are paid, it would, in effect, tarnish our revenue stream. I mean, I'll give an example. Doing structured finance or even munis, where primarily the form of compensation is from the issuer and based on the dollars rated, where, in effect, in order for, say, a firm like ours to cover, say, structured finance, we'd have to cover everything, which, how many thousands of structured finance deals are out there? I mean, so so something like that, what happens is the weakness of the revenue model for us sort of restricts us from entering certain types of business just from a practical standpoint. And and as long as we keep the same model, because we don't want to take the risk of having to set up, because I know the guys at S&P and Moody's, you have to set up you have the rating business development side, then you have your other subscription business side, and then you have all these different structures within that, and it would just be too, frankly, it would just be too costly for us to change our model from where it is. So we literally would just have to satisfy ourselves with growing our client base just by continuing to deliver timely ratings, be as accurate as we possibly can. And again, our life's blood is in the quality of our research. I mean, if we lapse one bit, then you lose a client. You lose a client, then you lose more, and you lose more. So it's the one thing that I've noticed, that working for an issuer-paid firm, you didn't have to put out as good a report as it could have been. But a firm like us, where our life's blood is this, our reports have to be great all the time. Otherwise, some of our clients show zero tolerance for, not just, rating agencies can make a mistake, but, at least on a rating. But again, it's, the motivation for us is just to constantly make sure that everything is correct before it goes out the door, which sometimes is a very tall order. But it's the revenues. From our ability, the weakness sort of prohibits us from going into rating certain asset classes, mainly just because the nature of the way compensation is.
You're missing network effects that you have to get in place before it makes economic sense. Exactly. All right, Jim.
As I was saying, whoever pays you, there's an inherent conflict. And rating agencies have all, the issuer pay rating agencies have all done balance sheet ratings for investors. And when an investor comes to you to do a rating on a pool of something or a company that they bought that doesn't have a rating, they want the same thing that an issuer who comes to you to pay for a rating wants, and that is They believe in something that they bought, and they want a high rating. So the conflict isn't whether an investor pays or an issuer pays. The conflict is whoever pays. There's a conflict, and there are a set of conflict. And I think it boils down to being a grown-up. You, as a rating agency, you're entrusted with this power, this NRSRO that over time was given to you by the SEC, and over time has grown to mean something, although it's taken a black eye in the crisis. And so I go back to looking at the ways that a rating agency can let the investing public know that they're doing the right thing. Transparency is one way. If all of your methodologies are out there and there are no black boxes, it's very difficult for you to prefer one client over another client, or treat one pool of assets differently than you treat another pool of assets, because you basically told the world the way that you're going to look at that company or that sector or those set of assets. And when I say transparency, I don't mean the type of transparency that says, well, we sort of do this and we sort of do that. I'm talking about stating very clearly what your model does and very clearly what your analysts do and where your analysts can make judgment calls and the types of things that they look at that allow them to make those judgment calls. So full transparency. You have to be careful with transparency, though, because the other thing that rating agencies should be doing as good citizens in the capital markets is they should be encouraging original research in all of these areas and looking at things differently. And so you don't want to become a check the box. You don't want to have this transparency that says, well, we did this, and then we did this, and then we did this, and so the rating's fine. You want to encourage your analysts to continually be looking at new ways of analyzing things, new data that becomes available. So it really boils down to management's viewpoint and management basically taking the responsibility that they bear in the capital markets seriously. And that's where I think investors should continuously challenge rating agencies. I like nothing more than sitting down with an investor and having them ask me to go through the litany of why I think they should use a Kroll rating and why I think we're different than the other rating agencies, starting with the top management and what we do that's different than the other rating agencies and how we would prevent rating shopping, all the things that Mark described that are sort of bad for the industry and are the negative side of the issuer pay model.
Okay, very briefly.
Yeah, I want to just develop on something that Bill and Jim alluded to. Based on the question, we were highlighting sort of the dark side of the two business models, but with some counterbalance of what the benefits are. But there's one that I want to develop just a little further for a second, and that is coming from the transparency idea, but it's the coverage idea. That with the issuer pay model, one of the things that happens is the ratings themselves and a fair amount of their accompanying research becomes widely available, virtually a public good, so that the market as a whole is really able to function using the information, and presumably prices get to reflect that information because it's widely known. With a pure subscription-based model, in order to be able to continue to get value selling subscriptions, you really have to restrict the dissemination of the information. And it means that you can't have every market participant be able to just look up what is a rating, what is the rationale behind the rating. And maybe Bill's going to want to add something to this, but I think it's the case, Bill, that you can't simply go look up an Egan-Jones report, right? Or an Egan-Jones.
You have to actually buy a subscription to an Egan-Jones rating service in order to get the information from the report or even find out what the rating is.
Yeah, so there's a pretty serious implication for the market if you said, for example, all the rating agencies go to pure subscription, and now there are no ratings publicly available. Okay, there's no going on your Bloomberg machine, typing CRPR and seeing what the ratings are. Okay, the market becomes very dark in a hurry in a pure subscription world.
Okay, I have another question I just want to throw out to the panel, and then we'll open it up for the last several minutes for some questions. But I think the question that really gets to the heart of the business model is how do you pay for surveillance? We've talked about that a little bit, right? That as you have the model in the past, and if you have the designation, your NRSRO, you could, if you chose to, become a toll taker, in a sense. You could, because there's a limited number and that it's mandated that everyone looks towards ratings, you wouldn't have an economic incentive to really push the envelope in sending people out and really digging under the hood of all of these ratings or all of these issuers. So if anyone would like to comment, I'd say, how do you pay for the cost of surveillance? Go ahead, Jim.
You raise a great issue, and I think that there are a couple of ways to look at it. First, you have to look at, I separate surveillance two different camps. There are the frequent issuers, and those are municipals and corporates that issue frequently. And then I put structured finance and infrequent issuers in a separate group. So with respect to industrial companies, banks, and municipals that issue frequently, surveillance really isn't an issue because the rating agencies are basically updating their rating, and if they're doing a good job, updating the rating and getting paid as these companies and these municipalities issue new ratings. Structured finance is a separate case in that you've got this ongoing responsibility to surveil these issues, and that in many cases lasts for 30 years. And it came to light in the financial crisis that the incumbent rating agencies weren't doing the type of surveillance that I think investors thought they were doing, and we saw these sort of mass downgrades. And having been an investor at the time, it was disturbing to see these mass downgrades and then sort of pick through and say, well, wait a minute, why'd you downgrade that? Oh, sorry, it just got put in with the mix. It really shouldn't have been downgraded. We'll take it back up. And so I think it was just a symptom or a sign that they really hadn't been doing the surveillance. And again, I think it gets back to being a grown-up. I mean, when you took on that rating and you looked at the liability that you were taking on and you've got a 45% operating margin, you really can't claim you're not getting paid to surveil the issues. You really should have implemented it earlier, and you really should have done it. That's the one area that I think the regulation has been right on target in saying that surveillance is an important part of what you do, and and you should make sure that it is a key focus of how you price your service and what you do. The last thing is infrequent issuers, and this happens a lot in munis. And you brought up another issue as well, and that is the lagging information. So you've got a double problem when you've got an issuer that comes to market, say every 5 years, a small school district, and they're a year and a half behind on putting out their financials. That is a specific problem that I think the rating agencies can help become more of a sort of a nudge with the municipalities in finding ways to get information to the public in a reasonable time frame. If they don't have the information available publicly, rating agencies should be calling the school district and finding out what's going on, what's happening in the district. You don't give me information that you're not going to share publicly, but at least get a feeling for what's going on in those small districts. But that is a continuing problem and not easily addressed either from the issuer standpoint or from the rating agency standpoint, because in many cases these small school districts don't have the money themselves to do the sort of provide the sort of information on an ongoing basis that they need to. And maybe the rating agencies need to be better about explaining exactly what the rating means in those instances and exactly what the surveillance process will be on a small, infrequent issuer so that everyone's aware and the risk could be more easily priced into the security that you buy.
Okay. Excellent. Well, thank you all for your attention. Let's turn some time to our questions in the back.
I have a question for Bill first, and then for all three panelists. Bill, you talked about the next crisis coming, what you expect. I was wondering if you could talk a little bit about what that is. And then for all three panelists, I wanted to ask what your current rating is on the U.S. sovereign debt, and if you foresee another downgrade.
Okay, I'll take the last part first because, again, we actually have disagreements in the office as to when we think the real problems are going to be hitting not just the U.S. but the rest of the world. So we have the United States at a AA+, right, and the outlook is evolving. Frankly, I think that there would be some triggers that would warrant a downgrade. For example, if Mr. Bernanke decided to do a QE3, that would probably trigger a negative action on our part. I would probably, as the lead analyst, be leading that charge for a negative action. On where I think there's, again, without having to go through all the details, I come from a banking background, and there's some very issues here in the world that are in banking that should scare the daylights out of any reasonable person. Just throw a couple of things out here. If you look at the profitability of U.S. banks, the big ones and even the regionals, the one thing they have all in common is that there's no real organic revenue generation. There's no organic capital regeneration rates. Their inability to self-generate capital is non-existent. Their results are as a result of, we can call them debit value adjustments, credit value adjustments, proprietary trading, lower provisions, releases of reserves. What do those things all have in common? Non-core traditional ways of generating revenues. At the same time, you're looking at a banking system that's continuing to shed assets, balance sheets that continue to shrink. Yet, we're supposed to be, as we're told, in an economy that's allegedly growing. Now, you have the economy that's supposed to be growing and the banks are shrinking. There obviously is a disconnect here. Also, we look at, I'm worried about what might happen today in Europe. Will the Europeans move forward with another 500 billion euro long-term repo facility? And the concern I have is the impact on the valuation of the euro with the first release of 500 billion euros. Now you're going to have another release of probably 500 billion euros within not even a 2-month period of time. Yet, where's the impact going to be on the actual value of the euro? The fact that the monetary statistics in Europe are so opaque, it's almost, well, if it's not here, then it doesn't exist. So those are worries, plus the overall health of the banks. The other little statistic, I don't want to hog the time, but the top 6 U.S. banks in assets, and I'm not counting the CDS outstandings that are for the bank, just from asset size, are equal to 65% of U.S. GDP. If you are one of those concentration buffs, that should scare the daylights out of you. Now, if you're in France, the top 3 banks in France by assets are 240% of French GDP. Deutsche Bank by itself is 68% of German GDP. Or better yet, I think the winner of the game are the British banks. The top 4 British banks have assets of 10 trillion plus versus a $2.2 trillion economy. The question is, everyone's talking about too big to fail. I think the opposite is, how could they possibly be saved? Someone's going to have to get hurt. And that's the part that how all this unwinds. And that's the part that, as an analyst, it frightens me going forward. Not the fact of the other economic issues such as inflation and, the continuous, I think twist continues to have a negative effect on the economy. So it's, you can see that, on the corporate results that we do. You see, every financial release comes to one theme we see in whether it's manufacturing, agriculture, input costs are up. Input costs are up. Yet, when policymakers are addressing this issue, it's almost as that doesn't exist.
Okay. Let's see if we're in the interest of time, we need to hurry along. Does
that.
anybody else have something they'd like to answer as far as the question goes? And then we have very briefly another 2 questions.
Sure. I'm probably the skunk at the picnic on the U.S. rating, and I'll tell you why. Having done an extensive municipal study and looked at states and come to the realization that something I've known for a while, the importance of ad valorem taxing power and what that means in the context of a rating. I also, as most people view the U.S. as, and for the time being, the U.S. continues to be the reserve currency for the world. I think rating agencies need an objective standard. I think it's hard when the standard that you use as a risk-free AAA becomes something less than that, than what you use as a standard, and then your scales get mixed. And so what I find that what the rating agencies really are rating in the case of the U.S. is the ability or the willingness of our politicians to do the right thing in a measured way, and we all look at the numbers. I mean, you don't have to go too far to see what the deficit is in the United States, what the potential is. But I think that while all of that looms, and I think we do need to be, I think we do as good citizens need to be critical of our politicians and make sure that they do the right thing. I think the history of the United States has been that the politicians eventually do the right thing. And it's for that reason we don't rate the United States, but I still would treat the United States as the AAA rating scale for the reasons I just cited, and see the move as by the other rating agencies to downgrade as a little bit more of a push toward politics, and saying, well, we don't like the fact that they did this, we don't like the fact they couldn't raise the deficit, the limit, well, those sorts of things. And I think that's sort of a little bit out of the purview.
Okay.
Well, in our case,
Yeah, we need to hurry
monetary
quickly.
policy
Go ahead.
had just as much to do with our downgrade as the deficit. I mean, when we look at a sovereign rating, it's not just the repayment risk. It's almost like a sovereign rating. It's like a report card. I mean, the unemployment statistics, the population demographics, whether you have real inflation versus the inflation that the Federal Reserve seems to only want to recognize, wage deflation. There's a lot of other factors that go into, and again, monetary policy and its impact on that overall economy, that was one of the main reasons why we downgraded back in July.
Okay. Very quickly, Mark, and then we need to do very quick questions. Mark's going to take 5 seconds here.
Yeah, we have a rating of AA+ on the United States. I want to be absolutely clear, this is not about a report card on the government or on American society or anything. It addresses specifically and solely the issue of repaying debt. That's the only thing any S&P credit ratings address.
Okay. In the back, please.
I have a question relating to Mr. Nadler's comment about the issuers, the analysts actually being involved in the negotiation of contracts. I worked for a rating agency for a while, and when I first started there, I actually had the contract in my files, but I was not part of the negotiation. By the time I left, I could not have the contract, I couldn't see the contract, I couldn't know what I was getting paid. So my curiosity is, how pervasive was this that Dodd-Frank felt obliged to comment on it, or was it just to be careful, and that's the reason why they put it in the document?
I think it was the 2006 Act that actually began the change in separating the two functions, and I think that it was surprisingly prevalent. I think that particularly in structured finance, where you had a lot of various assets coming to market, a lot of research going on, and I don't mean to imply that it was that it was always bad, because I think it was people trying to do the right thing, but stepping back at it, and let's say you're the CEO of the company, somebody should have looked at it and said, wait a minute, this makes no sense. Let's separate that function now before we're sort of pushed to do it in a more formalized way. But I think the rating agencies saw it coming down the road because it had been talked about before it got passed, and began to make changes as the conversations began to take place. So I think it evolved over time before the legislation actually happened. But it was very pervasive in the 90s.
Oh, absolutely. I couldn't agree more, because I actually, at Bankwatch, we had that very system in place.
So this panel could probably go on for a good long time. There's many loose ends here that we don't have time to explore. Let's go with the final question right here down in the middle. They'll bring a microphone to you.
just coming from an issuer-paid perspective, what can the panel comment on the optimum number of issuer-paid relationships that should exist between an issuer and the rating agencies? Thank you.
Somebody want to take that?
It varies for sector. You can have an issuer that follows monoline insurers before the crisis, and really those are very difficult to follow, and it's probably one monoline insurer per analyst. You take a sector like regional banks, you may have an analyst that's following 6 or 7 up to 10 regional banks.
I mean, as an issuer, should we have 3 issuer-paid relationships?
Oh, I'm sorry. Well, you should have a Kroll rating. Other than that, I'm not sure you need anything else. But
No,
They should have an independent rating as well.
Yeah, it's actually a very tricky question, and as you get to a larger and larger number of rating agencies, that becomes more challenging. One of the things that I don't think we're really going to talk about today too much is the question of the industrial organization of the credit rating sector, and that there probably is some research that ought to be done on what would be the optimal number of providers, because if you had very numerous rating agencies, each one might have so narrow coverage that you lose the ability to compare. On the other hand, you want to have some diversity of viewpoints, diversity of analyses, so that an investor can get multiple points of view on a credit. And there is value for investors when rating agencies disagree, because they're looking at things differently. I think it's safe to say that somewhere in the low to mid single digits is a reasonable kind of number for any issuer to have to deal with. But if it started becoming more than a dozen, I think that would be quite strange.
All right. Please join me in thanking the panelists for a very interesting discussion. Thank you.